If I was starting completely fresh as an investor in today's market with no experience and no fancy strategies and just what I have in my head, here's exactly what I would do. Before we dive right into the ETFs, let's talk money management first. This is very important because you can't invest what you don't have. And that is why I want to mention that budgeting is very important. Even if you're living paycheck to paycheck, it is important to make sure that you have a budget. That way you have money available to invest. That is the first secret that most beginners miss. Budget first and invest second. Okay, now let's get right into it, right? I wouldn't chase the next big hot tech stock or try to time the market either. Forget trying to pick Apple, Amazon, or some big AI company that everybody is hyped about. No, don't do that. That is not exactly what you want to do. Instead, you want to focus on three things. Three ETFs that are simple, beginner friendly, and designed to grow your wealth steadily over time. Now, let me be real with you. I am not a financial advisor, right? I am just sharing what I personally would do if I was starting fresh in 2025. Investing has risk, right? You can lose your money. But what I'm about to share with you is practical, beginner friendly, and something that you can start today, even if you just have $50 to spare. Stick with me because by the end of this video, you're going to have a clear step-by-step blueprint to start building your future wealth, even if you've never invested a day in your life. Now, let's pause here because some of you might still be thinking, but Fuanyi, what about Microsoft, right? Or what about Google? They'll never go broke. And maybe that is true. Sure, maybe they'll be in business forever. But let me show you a few companies in the past that were once seemed untouchable, but because they didn't adapt, their future changed dramatically. For example, Blockbuster. In the 1990s all the way to the early 2000s, Blockbuster was the place for movie renters, right? But when Netflix and streaming showed up, Blockbuster was too slow to pivot, and what happened to them? It's basically a punchline in business history. Let's also think about Kodak. Kodak dominated film photography. Listen, they even invented one of the first digital cameras, but they buried it because they feared it would help their film sales. That hesitation alone cost them everything once digital photography and smartphones took over. So let's take Nokia for example. At one point, they ruled the cell phone world, right? But when smartphones and apps took over, Nokia underestimated the shift altogether, and today their market share collapsed almost overnight. Another one is MySpace. Before Facebook and Instagram, MySpace was a social network, but poor innovation and bad user experience meant it lost its entire audience in just a few short years. And then we have Sears, as well as Toys R Us. They all suffered the same fate. Markets and industries are going to change faster than we think, especially with tech and AI evolving so quickly. Instead, I'll go broad, right? ETFs are perfect for beginners because they spread your risk and make investing less stressful for you. You don't have to track every single company, right? You just sit back and let your money grow for you. So what is an ETF and why is it perfect for beginners? An ETF or exchange traded fund is basically a basket of stocks. Instead of buying just one company, you're buying a tiny piece of hundreds of companies at once. For example, one ETF might hold Amazon, Apple, Coca-Cola, Visa, McDonald's. You get the idea, right? That means if Amazon has a rough year, your money is still spread across all the other companies. You don't have to monitor every single quarterly report yourself. Someone or an algorithm is doing a heavy lifting for you. Think of it as having a fruit basket, right? Instead of having just apples in your fruit basket, you got apples, oranges, bananas, and grapes as well. If one goes bad, you're still having other things to eat on, right? So let's take Dan, for example, right? He invested all his savings into one tech startup, right? It sounded promising, but when the product failed, he lost everything. ETFs are going to solve this problem. ETFs also remove the emotional stress that comes with buying individual stocks. You're not getting up every morning trying to check that one stock or panicking when your stock moves a few dollars. What you're doing is you're sitting back and you're letting compounding do the work. Alright, if I was starting from scratch today, the first thing that I'd buy is an S&P 500 ETF. And here is why. Well, think of it like this. Instead of trying to pick the next big thing, you're buying a slice of America's 500 biggest companies. That's basically like buying a piece of the US economy itself. You've got Amazon, Apple, Coca-Cola, Microsoft, all of that rolled into one fund. It's like buying a little piece of the entire market without having to stress about what single company is going to win. Some examples that people often go for are VO and SPY. And personally, I prefer VO because the fees are much lower. It's just smarter over the long run as well. And speaking of fees, here's a quick tip. VO's expense ratio is 0.03%. That's literally 3 cents for every $100 that you invest per year. SPY is a bit higher at 0.09%. That sounds really tiny, right? But over time, that is going to add up in decades, and it's going to add up to thousands of dollars that you're going to save. Now, let's talk returns for a minute, right? Historically, the S&P 500 has given around 10% per year on average. And yes, the market goes up and down, right? But recessions also happen and markets are going to dip. It's not going to be a straight line, but over decades, it is one of the most reliable and safe places to start if you want long-term growth. Let's take Jane, for example. She decided to invest $100 a month in an S&P 500 10 years ago. Nothing crazy, just steady contributions of $100 a month. Fast forward to today, it's grown to over $20,000. And here's the lesson. Small, consistent steps beat trying to time the market every single time. So if you're thinking about where to start, an S&P 500 ETF is like planting a tree today. You might not see huge growth immediately, but give it time. Water it consistently, and in a few decades, you're going to have a massive tree with shade to sit under. Planting your tree at the age of 40 is going to give you less time to grow it big to have that shade. But if you plant it at the age of 20 or 25, by the time you get to 40, your tree will be grown enough and have the shade that it needs to provide you. So while you're 40 and you have shade, those who are starting in their 40s are still going to be digging the hole to plant their tree while you're busy enjoying the fruits of your labor. So remember to also start early and don't procrastinate. All right, next up, we got dividend ETFs. Now, listen, here's why I love these. It gives you cash flow, baby. Listen, instead of just sitting around waiting for your stock to double in value, dividend ETFs are going to pay you while you're waiting. It's like your money is working a side hustle for you automatically, right? Think of companies like McDonald's. They make billions every single year, and a portion of those profits goes straight to their shareholders in the form of dividends, which is literally free money hitting your account every month or every quarter, depending on how often they pay out. Some ETFs that I personally like are SCHD, which focuses on US dividend champions, as well as VYMI, which gives you international dividend exposure. VYMI is a little bit more adventurous, but it can actually really boost your returns if you are consistent. And here's the thing, dividends start really small. I'm talking pennies at first, right? But that is okay because consistency is where the magic is going to happen. Over time, those little payouts are going to compound and suddenly your money is making money for you. And that is the kind of passive income that can actually cover real expenses down the line. So picture this, you invest $100 a month into a dividend ETF starting at age 25. Fast forward 20 years later, and those dividend payments alone can cover your groceries, utility bills, and even a weekend getaway for you, all while your original investment keeps growing in the background. Quick heads up, dividends are taxable, so keep that in mind when you're planning your long-term strategy. But don't let that scare you at all. It's still one of the easiest ways to start building cash flow for life. All right, now let's focus on growth ETFs. Listen, these are the funds that actually focus on companies reinvesting their profits back into their business. Think tech startup, innovative companies, and fast-growing industries. That means they can be a little bit risky, but they also have higher potential as well. Basically, you're aiming for those big win opportunities, but without putting all your eggs in one basket. A couple of my favorites are QQQ. It tracks the NASDAQ 100, and it's packed with tech. I also like VUG. It's Vanguard's growth fund and focuses on innovative US companies. Now, let's be real, right? These are not the calmest investments. Their prices can swing up and down. But that is why I like to pair growth ETFs with the S&P 500 ETF and dividend ETFs as well. It's all about balance, some stability, some cash flow, and some real growth potential. So take Thomas, for example. He jumped into a tech growth company in 2017, right? And some of the companies have gone under. Yep, total losses. And others doubled or even tripled. By keeping a diversified approach, the overall portfolio ended up netting positive, right? That is proof that balance and patience really do pay off. So yeah, growth ETFs aren't just set it and forget it, just as the S&P 500 is. But when you use it wisely, it is going to add exciting growth piece to your investment portfolio. All right, now let's talk about a fun one, which is niche ETFs. ETFs are not just for big, broad markets, right? They can actually let you target specific trends or industries that you actually believe in. Think of it like betting on a whole team instead of betting on just one player. For example, we have BOTZ. It focuses on AI and robotics. And if you think automation and AI are going to dominate the next decade, then this is a way to invest in the entire sector. Also, there's AG&G. It focuses on aging populations, right? With people living for long, some of these companies are in growing markets for healthcare, services, and technology for seniors. Another one is IYG. It focuses on financial services, right? Think banks, fintech, insurance. You get exposure to the financial world without actually picking just one single company. And here's the key. If you see a trend and you want to be part of it, investing in a niche ETF is going to help you spread your risk across the whole sector instead of investing in just one company and taking more risk. It's safer, easier, and beginner friendly. It's kind of like dipping your toes into a pool before you jump all the way in. Now, let me tell you how I'll actually put money into the market. I'll follow something I call the ABB method, which is always be buying. It's also known as dollar cost averaging. Here's the deal. Instead of trying to guess the perfect time to invest, because spoiler alert, nobody can consistently do that. Just set up automatic contributions, right? It could be weekly, bi-weekly, or monthly. Because I'm a retired vet and the VA pays me monthly, what I do is invest monthly instead because it fits my pay schedule. If the market crashes, it doesn't matter. If the market is booming, it doesn't matter. The key is showing up consistently. And that is how wealth is built over time. And here's a little mindset trick for you. When the market dips, don't panic, okay? Think of it as a sale on stocks. You're actually getting more value for your money. When the market is soaring, just keep buying. You're sticking to the plan with no emotions involved whatsoever. Consistency is going to beat timing the market every single time. That is why ABB works so well. It removes the stress and decision fatigue and turns investing into a very simple habit. Here's the thing. Investing is not a sprint. It is just a marathon, right? You're not going to get rich overnight, no matter what anyone tells you. Think 10, 20, and 30 years down the line. That is when the magic really happens, right? And honestly, the biggest mistake I see beginners make is not picking the wrong stocks or the wrong ETFs. It's not investing at all. The mistake they made is sit on their money, hoping the perfect time would come. And before you know it, years have passed, decades have passed. The key is to start small. Even $50 a week, $100 a month, or whatever you can consistently manage. Those tiny, steady investments are going to add up over time. It's like planting seed now. You water it consistently, and eventually, you have a tree big enough to sit under and enjoy the shade, right? Consistency is your superpower. Over time, those small habits are going to compound into real wealth, and that is how you actually win the long game. All right, let's talk about your mindset shift for a minute, right? If you want to start building real wealth, you've got to start thinking like an investor would, right? That means stopping the habit of spending money on things that lose value while ignoring your financial future. Think about that $100 that is sitting in your bank account right now. Most people see it and think, new shoes, right? Maybe a night out with my friends and family. But what if you flip the script and then ask yourself this: how can I make this $100 work for me? Even small moves can make a huge difference. You can start putting money into a portfolio that grows over time, generates cash flow, and eventually helps fund your life so you don't have to rely on your paycheck alone. Keep it simple at first, right? S&P 500 ETFs for stability, which is your foundation. Dividend ETFs for cash flow, money coming to you while you are sleeping, right? Growth ETFs for upside, right? Which gives you potential big gains over time. What is the key here? Start really small, stay consistent, and adjust as you learn and grow. You don't have to get it perfect the first time, right? Here is the bottom line. Don't wait for the perfect time to start investing. There is no such thing as the perfect time. Start small, stay consistent, and let your money work while you focus on building your life. And always remember that investing starts with having money to invest. That is why I created the Financial Freedom Budget template. It's more than just a spreadsheet. It's a system that helps you always set aside cash for investing, even if you're living paycheck to paycheck. I'm going to drop the link to this budgeting tool in the description box below. The stock market, listen, it is not scary. It is a tool. Use it wisely and start now, and your future self is going to thank you. And if you found this video helpful, then don't forget to share it with a loved one who is going to find this information very helpful. Also, don't forget to like, share, and subscribe to the channel as well. Thank you so much for watching. And before I let you go, always remember that the best time to invest in yourself was yesterday. The second best time is now. You got this.